Prateek, good morning. Thank you for joining us. What do you make of the construct of the market? I mean, the party continues in the small and the mid-cap stocks. Is this a rising tide phenomenon or gains are here to stay? I think you're on mute. Unmute, please.
Good morning. No, we keep doing the pulse check on the market. Now, 2 points. One, we believe market levels on the large cap side are sustainable, and mid caps, while they are trading higher than long period average versus large caps, should still be seen to be in a sustainable zone. A time correction is what we anticipate. The thing is that most of the growth themes that one is glued onto at the moment practically all lie in the mid cap space.
Prateek, why has IT made a comeback where nothing is going right, and why are banks underperforming where everything is going right?
So in banks, if you have change in guard or expected change in guard, investors want to pause and see how the new management will function. So a lot of the large private sector banks are seeing expected to see that, and that is causing some consolidation there. And then in the marketplace, names which are not seeing it get measured versus somebody else which is looking similar and also consolidate. Whereas on the IT side, if there is a change in guard and let's say a guy from a larger outfit comes and joins a significantly, relatively speaking, smaller outfit, well, he is expected to bring with him certain amount of business and business relationships, which are positive, which is a positive for that space. So I think you put both together. So this is one common factor working differently for the two spaces.
Looking at your schemes and then looking at the holdings there, while financials is right up there, there is a lot of presence of some interesting names: Zomato, Tube Investments, Deepak Nitrate. So I'll start with Zomato. Or when I say Zomato, consumer tech and fintech. Is the worst genuinely behind some of these stocks? Do you genuinely think that the path of profitability, what they are committing to, is going to be here and they will continue to grow without compromising on the growth? Because the minute you cut growth, profits come back. But you cut growth, markets would say these are high growth companies.
No, so we have been positive the new tech space, especially companies which have committed to turn profitable in the foreseeable future. And as long as they stay on the path, I think the skepticism that is there in the marketplace will slowly evaporate, leading to good gains. Is one thought. Now, I think the comment that you made that if you aim for profitability, growth goes, and vice versa. When you make that transition, that should be expected to happen. But as you go deeper into the transition, and if all players in this space act similarly disciplined manner, the transition would be smoother, and sooner than later, one should expect to see both playing out, volume growth and better margins. So it's a matter of time. I mean, in many of these businesses, our own behavior of friends, family, and the next generation, if one observes, one would believe that these businesses have a lot of legs. And some of these businesses, if you look at them on an incremental revenue basis, the kind of delta change in EBITDA that you see will then point out the richness of those businesses.
So what is that core change you've done to your portfolios between April and now? I mean, is there a core change in terms of positioning which you've changed?
No, so across the house, what we do is to flesh out very narrow themes and expect managers to represent them strongly in their portfolios. While the names pertaining to those themes, depending on the market cap positioning, etc., the manager chooses on his own. So in terms of themes, we may have made it sharper, but as such, we have not changed the themes. We continue to believe in granular small ticket lenders, be it NBFCs, be it banks. We continue to believe in new tech. We continue to believe in newer businesses, let's say on the EV side, the engineering and defense, NASA, and all of that. So all of those businesses continue to be part of practically all of our portfolios.
Right. Prateek, but there's got to be some part of the market where you're a little watchful now, or maybe even, recommending or wanting to take profits off the table. What are the pockets which are looking overvalued to you?
No, so yeah, fair question. But surprisingly, some of the uh, spaces which may have just started to participate in the market may be overvalued. Uh, you know, I keep debating this, but I do believe certain businesses like pharmaceuticals, when you speak of them, you believe they are steady, decent growth businesses, but they have a lot of headwinds, and a lot of risks attached to regulations and so on. So while on your valuation metrics they may look fine, I think that is a space where at least I do believe that there is some amount of fluff coming in, because except for the India business, which is branded generic and can seem to be sustainable, there again there is this competition from generic which is emerging. But X of this, the export business, be it generic, be it bulk drug, be it whatever, is all commodity, where ascribing it pharma valuations of 20 times and so on doesn't make sense to me, frankly. So that bit, but otherwise, a lot of these spaces which have been doing well for 7, 8 months, fair enough, and we have been exposed to many of those. I think the big delta part, the outperformance part, the large part of it, we should expect it is behind. While these spaces can continue to perform, but maybe a tad ahead of the market, not ahead of the market in a large manner.
Uh, Pratik, is there a bubble in defense and railways? When I say bubble, near term, I'm not talking about the theme, I'm not talking about the intent, I'm not talking about the business cycle. I'm purely talking about a valuation bubble. When stocks go at P multiples of 100 times plus, you call them a valuation bubble. It is not a business bubble.
No, so in defense, we are not looking at smaller companies. The construct is that Indian budget expands, slightly more than the expansion of the economy in nominal terms as the tax intensity improves, tax compliance improves. Defense as a part of GDP should be expected to grow a tad lower than the budget overall revenue growth. But within that, the salaries kind of stuff will grow slower. The capex should grow faster, and then in the capex, the what does get done in the country grows faster than what gets imported. In fact, one should expect imports to be stagnant in dollar terms. So that gives you a 14-15% kind of sales CAGRs for the platform companies, and with some operating leverage slightly higher profit growth possibly. So we have stayed till the platform companies. We have not gone to the next level. There was a hope that the next level we could see even stronger growth, because indigenization was the buzzword. But what we are observing is that the platform companies split orders and develop more than one vendor. So while overall, one down to platform will grow faster, but the business gets split. So one company should be expected to grow only similar to the platform company and with higher risk. So we have stayed with the platform companies, and there don't think the valuation bubble you are talking of exists.
Thank you for taking time out and joining in and giving us your view on the markets. That's the take coming in from Prateek Agrawal.